October 12th, 2008. Harare, Zimbabwe. A teacher walks out of the bank holding a piece of paper. Not a check. A banknote. It reads, $100 trillion, enough to buy 3 eggs. She stands at the bus stop. The fare was $50 billion this morning. By noon, it's $100 billion. By 3 p.m., the driver refuses payment entirely. Bring me bread instead, he says. The money died faster than she could spend it. This isn't fiction. This was Zimbabwe, 2008. And it's happened 27 times in the last century. Venezuela, Argentina, Weimar Germany, Yugoslavia, Lebanon, Turkey. Different countries, different decades, identical pattern. Here's what no one tells you. Your currency has a lifespan. Not might fail, not could collapse. Will fail. The average fiat currency lasts 27 years before it dies or gets replaced. The US dollar became fiat in 1971. That was 54 years ago. We're living on borrowed time. But here's the part that changes everything. When currency dies, wealth doesn't disappear. It transfers from those holding paper to those holding real assets. I spent 8 months dissecting every major currency collapse since 1920, not reading theories, pulling forensic data, court records from Weimar Germany, central bank archives from Argentina, refugee testimonies from Venezuela, banking collapse documents from Lebanon. What I found follows a mathematical pattern so predictable it's terrifying. By the end of this video, you'll know which 5 assets multiplied in value when everything else burned, which 2 investments evaporated to absolute zero, where the exact same warning signs are flashing right now. This might be the most important 19 minutes of your financial life. Let's go. First, the collapse formula. Every currency collapse follows 5 identical stages. Not similar. Identical. Stage 1, overspending. Government spends more than it collects in taxes. Stage 2, money printing. They print currency to cover the deficit. Stage 3, purchasing power erosion. Prices start rising. Slowly at first, then exponentially. Stage 4, flight to alternatives. Smart money flees to gold, foreign currency, hard assets. Stage 5, systemic collapse. Currency becomes worthless. Society reorganizes around new money. Every single time. Let me show you the math. Weimar Germany, 1922 to 1923. January 1922, 320 marks per dollar. November 1923, 4.2 trillion marks per dollar. That's not a typo. In 18 months, the mark lost 99.9999% of its value. A loaf of bread went from 250 marks to 200 billion marks. Workers were paid twice per day because prices doubled during lunch. Families burned cash in their fireplaces because it was cheaper than buying firewood. Zimbabwe, 2007 to 2009. 2007, 30,000 Zimbabwe dollars per US dollar. 2008, 2.6 billion per US dollar. 2009, 35 quadrillion per US dollar. Inflation hit 89.7 sextillion% per month. Prices doubled every 24.7 hours. The government printed a $100 trillion note that couldn't buy a loaf of bread. Venezuela, 2013 to 2019. 2013, 6.3 bolivars per dollar. 2019, 25,000 bolivars per dollar. 2024, over 36 million bolivars per dollar. A country with the world's largest oil reserves saw 94% of population in poverty. 7 million people flee the country. Average person lost 23 kilograms body weight from starvation. Doctors earned $5 per month. Lebanon, 2019 to 2024. October 2019, 1,507 pounds per dollar. Official peg since 1997. January 2020, 2,000 peg breaks. December 2021, 33,000. March 2024, 89,600. 98% currency destruction in 4 years. A doctor who saved $100,000 over 20 years woke up with $2,000. Same pattern, same stages, same outcome. Now, let me show you what survived. Asset number 1, physical gold and silver, the 5,000-year survivors. Here's the uncomfortable truth no financial advisor tells you. Gold doesn't need to do anything. It just needs to not be printable. During Weimar hyperinflation, if you held 1,000 marks in cash on January 1st, 1922, worthless by November 1923. If you held 1 gold coin on January 1st, 1922, still bought the exact same basket of goods in November 1923. The currency changed. Gold didn't. Zimbabwe, 2008. While the Zimbabwe dollar was collapsing, gold miners became the wealthiest people in the country. Why? They were paid in gold, which they could exchange for US dollars or South African rand at stable rates. While teachers holding Zimbabwe dollars lost everything, gold holders maintained 100% purchasing power. Venezuela, 2016 to 2024. Venezuelans who bought gold in 2016 at $1,200 per ounce can now sell it for bolivars worth the same purchasing power? Those who held bolivars? Total annihilation? Turkey, 2024. In Q4 2024 alone, gold-denominated deposits at Turkish banks surged from 1.36 trillion lira to 2.72 trillion lira. That's 100% increase in 90 days. Why? Because Turks recognize the pattern. Runaway government spending, currency printing, inflation accelerating. Stage 4 behavior, flight to alternatives. They're doing what humans have done for 5,000 years, fleeing to money that can't be debased. But here's what most people miss about gold. It's not an investment, it's insurance. 2008 financial crisis. Gold crashed initially, down 30%, as liquidity froze, then rose 166% over the next 34 months. Silver rose 448%. 1970s. Stagflation. Gold fell 47% from 1974 to 1976. Then surged 738% from 1976 to 1980. The pattern? Gold gets crushed in the panic, then becomes the last man standing. You don't hold gold to get rich. You hold it so you don't get poor when everything else burns. Asset number 2, foreign hard currency outside the banking system, the lifeboat when your ship is sinking. Let me take you to Beirut, March 15th, 2020. 2 nurses, both 38 years old, both saved $50,000 over 15 years of grueling work. Nurse A kept her money in a Lebanese bank account, denominated in Lebanese pounds at the official rate of 1,507 per dollar. Nurse B withdrew her money in 2019, converted to US dollars, and kept it in physical cash at home. March 2020. The peg breaks. October 2021. Black market rate hits 20,000 pounds per dollar. January 2024. 89,600 pounds per dollar. Result, Nurse A's $50,000, held in pounds in the bank, now worth $560. Nurse B's $50,000, held in physical dollars, still worth $50,000, same savings, same time frame, 99% difference in outcome. This pattern repeats everywhere. Zimbabwe, 2008. Before official dollarization, Zimbabweans were already using US dollars in black markets. Street vendors refused Zimbabwe dollars entirely. Bring me US dollars, euros, or South African rand, they said. The government eventually gave up and officially dollarized in 2009. Venezuela, 2024. Even though bolivars are legal tender, no one uses them for major transactions. Rent? Dollars. Car purchase? Dollars. Electronics? Dollars. Bolivars are only used for small change. Argentina. You cannot buy property in pesos. Contracts are written in US dollars. Why? Because Argentines have watched the peso collapse 6 times in 50 years. They learned, never hold the local currency long term. Cambodia? ATMs dispense US dollars, not reals. Why? Because even the government doesn't trust its own currency. The lesson? When your domestic currency enters stage 3 or 4, access to stable foreign currency is the difference between maintaining 100% wealth or losing 98%. Not market volatility, survival versus annihilation. Asset number 3, stocks in companies with foreign revenue. This is the one most people get catastrophically wrong. But wait, if the economy is collapsing, shouldn't stocks crash? Wrong. Let me show you something that will break your brain. Venezuela's stock market in 2024. Caracas. Stock exchange, January 1st, 2024, 2,082 points. January 9, 2025, 6,127 points, plus 194% in 9 trading days. Individual stocks, Mercantil Banco, plus 200%, KNTV, plus 219%, Bankeride Provincial, plus 171%, economy collapsing, currency dying, stocks exploding. How? Because stocks aren't paper. They're ownership in real assets. When currency collapses, the nominal price of real assets rises to reflect the debasement. Here's the mechanism. Imagine a Venezuelan manufacturing company worth $100 million in real productive capacity. Factories, equipment, inventory, land. Exchange rate moves from 10 bolivars per dollar to 30 bolivars per dollar. Stock price rises from 1 trillion bolivars to 3 trillion bolivars. Not because the company became more valuable, because it takes more bolivars to equal the same dollar value. But here's the critical distinction. Not all stocks survive. A company earning 100% revenue in collapsing currency? Real profitability collapses even as nominal stock price rises. A company earning 50% revenue in US dollars exports. Real profitability increases during devaluation. Why? Costs, labor, rent, materials, are in cheap local currency. Revenue is in stable foreign currency. Profit margin expands. This was proven in 1982. Latin American debt crisis. Companies with export operations thrived. Domestic-only companies collapsed. 1994 Mexican peso crisis. Exporters saw profit margins expand 40 to 60%. Domestic retailers went bankrupt. 1998 Asian financial crisis. Manufacturing facilities redirecting sales to export markets survived. Domestic-focused companies went to zero. The takeaway? Productive equities with international revenue streams aren't just survivors, they're beneficiaries of currency collapse. But domestic-only companies? They burn with the currency. Quick pause. If this is reshaping how you think about wealth preservation, hit subscribe. This is economic forensics. I show you the autopsies so you see the pattern before you become the next victim. It's free, unlike the financial education they don't want you to have. Now back to what survives when money dies. Asset number 4, consumables and barter-grade goods. What happens when the monetary system completely fails? Economic activity doesn't stop. It reorganizes around alternative currencies. Post-World War II, Germany, 1945 to 1948. The Reichsmark was so worthless, it was functionally abandoned. What replaced it? Cigarettes. American soldiers bought cigarettes from base stores for 5 cents per pack. They traded them with Germans for watches worth $200, cameras worth $300, family heirlooms, sexual favors. Why cigarettes? Standardized, every pack identical. Divisible, trade by stick or pack. Non-perishable, lightweight, universally desired. They had all the properties of money except one. No government issued them. Black markets near train stations in Berlin, Hamburg, Munich operated 24/7. Everything traded in cigarettes, railway tickets, 2 packs, forged ID papers, 10 packs. Food rations, 1 pack per day. Here's proof cigarettes functioned as real money. When Red Cross packages arrived at POW camps and dumped hundreds of thousands of cigarettes into circulation at once, it caused inflation. More cigarettes, chasing the same goods, equals higher cigarette prices. Exact same mechanism as fiat currency expansion. Venezuela, 2018 to 2024. As bolivars became worthless, barter networks emerged. Fishermen traded catch for flour. Farmers traded vegetables for medicine. Mechanics traded labor for food. Items with value, antibiotics, insulin, baby formula, gasoline, batteries, water filters, soap, anything with immediate utility became tradable currency. But here's the limitation. Consumables are consumed. You can't store wealth long-term in batteries and aspirin. They're tactical, not strategic. Optimal allocation, 5 to 10% of crisis portfolio in physical consumables for immediate barter liquidity. 90 to 95% in assets that don't evaporate when used. Metals, foreign currency, productive equities, land. Asset, number 5, agricultural land with export crop capability. The asset that produces the one thing humans will always pay for, calories. Great Depression, 1929 to 1939. Urban dwellers faced unemployment, evictions, breadlines, starvation. Rural farm families had gardens producing vegetables, orchards producing fruit, dairy cattle producing milk, chickens producing eggs. They could skip new clothes. They couldn't skip eating. Venezuela, 2018 to 2024. Agricultural landowners maintained ability to produce food regardless of currency chaos. Urban real estate owners faced tenants who couldn't pay rent in any meaningful currency. Land produces calories. Urban real estate produces rent, denominated in collapsing money. Calories win. But agricultural land has 3 severe vulnerabilities. Vulnerability, number 1, illiquidity. You cannot move it. You cannot quickly sell it. If political conditions deteriorate and ownership becomes unsafe, you're trapped. Zimbabwe, 2000 to 2010. Robert Mugabe's government enacted fast-track land reform. 4,000 plus commercial farms seized without compensation. Sophisticated agricultural operations destroyed. Farm equipment looted. Irrigation systems dismantled. Result, agricultural output collapsed 60% in 1 decade. Farm values declined 75% between 2000 to 2001 alone. White commercial farmers who'd operated for generations lost everything overnight. Vulnerability. Number 2, taxation. Land cannot hide. Governments know exactly where it is, and they can tax it into oblivion to raise revenue during a crisis. United States, 1930s. During the Great Depression, property taxes remained constant even as agricultural prices collapsed. Farmers who couldn't pay lost their land to tax foreclosure. Entire generational farms were auctioned off for pennies on the dollar. Vulnerability number 3, revenue currency. Agricultural land producing export crops, coffee, cocoa, timber, soybeans. Revenue in stable foreign currency. Agricultural land producing only domestic crops, local vegetables, grains for domestic market. Revenue in collapsing local currency. The strategy, own land that either produces export revenue crops, foreign currency income, is located outside the collapsing jurisdiction, or is held through offshore legal structures that protect against seizure. Agricultural land maintains fundamental value through calorie production, but it's less liquid and more vulnerable to government interference than precious metals or internationally traded equities. Now, what goes to absolute zero? Understanding what fails is just as important as knowing what survives. Zero. Number 1, government bonds denominated in collapsing currency. Being a creditor to a failing state equals guaranteed annihilation. Weimar Germany, 1923. Germans who held government bonds denominated in marks watched their investments become worthless as the mark evaporated. A 10,000 mark bond purchased in 1920 was worth in 1922 enough to buy a house. In 1923, wouldn't buy a postage stamp. Argentina, 2001, government defaulted on $82 billion in debt. Bondholders saw values slashed by 70% in restructuring. Even this reduced amount required years of legal battles to collect. Many bondholders received 30 cents on the dollar in 2016, 15 years later. Greece, 2012. Private bondholders took a 53.5% haircut in debt restructuring. 100,000 euro bond became 46,500 euros overnight. The core problem? Fixed income securities equals claim denominated in collapsing currency. When currency collapses, claim becomes worthless. This isn't market failure, it's mathematical certainty. Zero. Number 2, bank deposits in domestic currency. But my money's insured. Insured in what currency? Lebanon, 2019 to 2024. October 2019, Lebanese citizen deposits $100,000 in a Beirut bank. Account denominated in Lebanese pounds at official rate 1,507 per dollar. Account shows 150.7 million pounds. January 2024, exchange rate 89,600 per dollar. Account still shows 150.7 million pounds, but now worth $1,682. 98.3% purchasing power annihilation. The number stayed the same. The value disappeared. Cyprus, 2013. Banks froze all accounts during financial crisis. When they reopened, deposits over 100,000 euros were bailed in. Depositors lost 47.5% of everything above 100,000 euros. 200,000 euro deposit became 147,500 euro. Overnight, no vote, no appeal. The lesson? Bank deposits in a collapsing jurisdiction are claims against a failing system. The government can freeze accounts, impose capital controls, confiscate deposits, bail-ins, devalue the currency, effective theft. Your money, their rules? Where are the warning signs flashing right now? Pattern recognition only matters if you can see the setup before it executes. Let me show you where we are in the 5-stage collapse cycle. Iraq, stage 3. Warning signs: financial crisis due to lack of cash liquidity. 70% plus of money supply restricted due to banking withdrawal controls. Iraqi dinar devalued from $1,190 to $1,750, unofficial. Currency smuggling across borders, public distrust of banks. This is stage 3 behavior. Purchasing power erosion. Turkey, stage 4. Warning signs: gold deposits doubled in 3 months, flight to alternatives. Inflation running 65% plus annually, official. Likely 100% plus, real. Lira devalued from $7 2020 to $34 2024. Citizens converting savings to gold and dollars. This is stage 4 behavior. Flight to alternatives has begun. Lebanon, stage 5. 98% currency collapse already executed. Banking system technically insolvent. Capital controls still in place after 5 years. Dual exchange rates, official versus black market. This is stage 5, complete systemic failure. United States, stage 2, entering stage 3. Here's the elephant in the room. $36 trillion in national debt, $2+ trillion annual deficits, debt to GDP ratio 123%, higher than World War II. Interest payments on debt now exceed military spending. Federal Reserve balance sheet expanded from $800 billion 2008 to $7.7 trillion 2024. Currency reserve status, dollar's share of global foreign exchange reserves, 1970s, 85%. 1999, 71%, 2024, 58%. Same trajectory. British sterling followed during its collapse as world reserve currency. 1913, Britain equals world's largest creditor. 1950s, Britain equals net debtor. Dollar replaced sterling. The pattern is visible, if you're willing to look. The brutal truth. Currency collapse is not a hypothetical future event. It's the historical norm. Lifespan of fiat currencies. French franc, 1960 to 2002. 42 years. German Reichsmark, 1924 to 1948, 24 years. Argentine Peso Ley, 1970 to 1983, 13 years. Brazilian Cruzeiro, 1942 to 1986, 44 years through 4 redenominations. Zimbabwean dollar, 1980 to 2009, 29 years. Average lifespan, 27 years. 99% of all currencies that have ever existed no longer exist. The question is not if your currency will fail. The question is, will you be positioned to survive when it does? Recap. The 5 assets that survive. 1. Precious metals, gold and silver. Universal store of value governments can't print. 2. Foreign hard currency, physical, outside banks. The escape valve. 3. Productive equities with export revenue. Beneficiaries of currency devaluation. 4. Consumables and barter goods. Tactical liquidity when systems freeze. 5. Agricultural land, export crops. Produces calories and foreign currency revenue. The 2 investments that go to zero. 1. Government bonds and domestic currency. Creditor annihilation. 2. Bank deposits and collapsing currency. Purchasing power wipeout. The lesson. You don't need to become a doomsday prepper hoarding gold in a bunker. You don't need to abandon all domestic assets. What you need? Genuine diversification across collapse-resistant asset classes. A portfolio consisting entirely of equities in one country equals catastrophic risk if that country collapses. Bonds in one currency equals guaranteed destruction if that currency fails. Bank deposits in one jurisdiction equals confiscation/devaluation risk. A genuinely resilient portfolio includes 10 to 20% precious metals, insurance against monetary system failure, 20 to 30% foreign currency assets, protection against domestic currency collapse, 30 to 40% international equities, companies with export revenue streams, 10 to 20% real assets in stable jurisdictions, land, property outside your home country, 10 to 20% cash/consumables, tactical liquidity for acute crisis. This isn't paranoia. This is pattern recognition. Contemporary warning signs in Iraq, Turkey, Lebanon prove currency crises are not relics of the past. The US dollar remains stable, but history proves this status cannot be assumed indefinitely. The most prudent approach isn't panic, it's positioning. Sufficient diversification across asset classes, currencies, jurisdictions means no single failure scenario can destroy your purchasing power entirely. History has already given us the answers. You just have to look at the autopsies before you become the next case study. If this fundamentally changed how you see economic risk, subscribe. Drop a helicopter emoji in the comments if you're already positioning for what's coming. I read every single one. The pattern is mathematical. The pattern is predictable. The only question, will you see it coming? Or be the one standing in line at the bakery wondering how bread costs $200 billion? Thanks for watching. Now go build a portfolio that survives the collapse.